So today we're going to go over flipping a flip to a rental. So what happens when your flip doesn't sell and you want to move it to a rental? Today we're going to go over one of those options, and that is moving it into a DSCR loan over a bridge loan or even conforming or a bank loan. So we're talking to investors every day. A lot of them, even ours, are asking us, what do we do with these flips that are not selling? Our biggest thing is make a decision, make it now. Stop lowering the price because that's just going to hurt you unless you really want to take that hit and move on. If you're looking at a rental, one of the best options out there is a DSCR loan. Yes, the DSCR loans has its negatives, which is a prepay, but one of the things we're going to go over today is showing you how that prepay is a lot less expensive than even doing a bridge loan. It is financially better for you to get in a DSCR loan than a bridge loan if you carry it typically more than 16 months. We're looking at a market that's not going to change for the next 2 years. So if you flip into a rental, use a DSCR, sit on it for more than 16 months, DSCR is the way to go. So before we start, what is a DSCR loan? A DSCR loan is a loan based just on the rent of that property, your credit score, and the loan to value. As long as you have at least a 640, maybe a 680, the better the credit score, the better the rate. A loan to value of 80% or below, and you have rents that match your monthly payments, which means your principal, interest, taxes, and insurance. And there are even products out there for negative cash flowing properties. There's always an option for you, and sometimes even having a negative AM loan or negative monthly cost to a loan is better than taking a big hit now. DSCR loans come in many shapes and sizes. You could do interest only, 40-year amortization just to keep those payments lower. You can get the 30-year typical amortization. The one thing you want to look at is what is the prepayment? How long do you have to keep that? They're usually matching, so if you have a 3-year ARM, it'd be a 3-year, but most products have at least a 5-year prepayment penalty. What does a prepayment penalty mean? That means if you pay it off anytime over that prepayment penalty term, which is typically 5 years. So let's just look at that. If you have a loan for 5 years, what they do is they have what is kind of like an exit fee. So the first year it's 5%, second year it's 4%, third year 3%, and so on. The longer you have it, the prepay goes down, but that's just to make sure that the lender knows that that money is going to stay out there for that period of time. It's part of the cost of doing this. What we want to do today is show you exactly why a DSCR loan is cheaper than a bridge loan after you hit typically that 14 to 16 month period. So the tipping point between a DSCR loan and a bridge loan is, like I said, usually that 14 to 16 month when it becomes cheaper to actually pay the prepayment penalty if you need to. If you're looking at keeping a loan for maybe 2 years or a property for 2 years, DSCR is better than a bridge loan. Your lender should be able to give you an analysis, kind of what we call a tipping point, where the bridge loan and the DSCR intersect and where it's cheaper to go with the DSCR loan. Anything under a year, bridge loans are the way to go. But if you go past a year, DSCR loans are the way to go to save you money. Not only does it save you money, but it gives you the peace of mind knowing that you have something if you have to stick with it for that 3, 5, or even 30 years. You have a product that's already there. DSCR loans, what you're looking at is an interest rate, you're looking at closing costs, and you're looking at a prepayment penalty. Well, let's look at some numbers. We're going to look at a DSCR that comes in at 8% interest. Hopefully that's a high interest. We're going to keep the points and the cost. We're going to put 2.5, and that's all costs. That's appraisals, title, everything. We're going to keep those the same. But we're going to put a prepayment penalty, of course, on the DSCR loan. In this case, we're going to pay it off before the end of 2 years, so it's going to be a 4% penalty. The penalty, of course, decreases per year, which makes the DSCR loan even more attractive. So let's dive in and look at these numbers. First of all, what are the raw numbers? What are you paying for that first year? And then when does it have that tipping point? Where does it cross that the DSCR loan is actually cheaper than the bridge loan? Now, if you look at this example, the $250,000 loan, DSCR loan, the first year's interest is going to be $20,000. The cost to close is $6,250, and that's in both loans. But there's a prepayment penalty, and that's 4%. That's after you've made it past the 1 year. Now let's look at the bridge loan. So every year you have a bridge loan, the interest is $27,500. So every year compared to the DSCR loan, you're actually paying $7,500 more per year. it's right around $600 more per month. So after year one, it's definitely cheaper to do a bridge loan. But in year two, if we look at month by month, we start to see in month 15, they're almost the same. But in month 16, now, even adding the $10,000 prepay, the total cost of having a DSCR loan and the total cost of having a bridge loan are basically the same. Anything past 16 months, the DSCR loan will be cheaper. And if you get past 2 years and 3 years as a prepay drops, it'll be even cheaper and cheaper. If you just think about it, you take a flip property, you got to put it into a rental, you do a 1-year term. You got to get those people out, got to get it on the market, and you got to get it sold. At the very least, in a slow market, you're probably looking at 14 to 16 months, 12 months for the rental, plus to get it fixed back up or cleaned back up on the market, sold and closed, you're looking at least that 16-month period. If you're looking at taking a flip, making it into a rental, even short term, you really need to look at the DSCR loan over the bridge loan. The bridge loan, great for the 1 year and under. DSCR loan will come out ahead as long as you're in that property for that 16 plus months in this case, but typically that's what it is. And if you're looking at any kind of rental, just like I said, 12 months for them to live in it, and then for you to sell it if you need to or you want to, then you also have to put that on top of that. One other small caveat is you could probably even take this after a year and do an owner carry, keeping the DSCR loan there. If you got some great information on this, like it, share it. Any deal you have that you're thinking about doing a rental, let us show your tipping point. Let us show you where the DSCR and the bridge cross. If you have something that's less than a year, more likely it's a bridge, but let's give you that exact time, the difference in payments, all those things. You need these numbers to understand exactly what's best for you right now. You want to make this decision quickly. You got to move on it quickly before rates go up, LTVs go down, terms get harder. Email us any deal you have. We'd be glad to look at it. If we can't help you, we'll show you who can help you. Literally scour hundreds of products every month looking for the best debt, the lowest loan to values, the best that deal with credit, any of those throughout the nation. So if you reach out to us, we could help you or we could tell you who could help you.